Hi everyone, welcome to our webinar today on COVID-19 tax measures. My name is Vivian Leung and I'm the Senior Principal of Taxation at CPA Canada. Joining me today is our VP of Tax, Bruce Ball. Hi Bruce.
Hi Vivian.
So this is the third recording we've done on COVID-19 tax measures, and the information around all the programs continue to evolve. The discussion today is going to focus on updates and developments since our last webinar. And if you're looking for foundational information on the Canada Emergency Wage Subsidy, I do encourage you to go back and listen to our April 16th recording where we cover the basics of the program. Now, there have been some changes since that time, which is why we have this webinar today, but the foundational information remains largely unchanged and it does provide a good resource. You'll be able to find this webinar on our webpage under the Tax Resources section. So before I get started, the other thing I want to mention is that we are going to be referring to the Canada Emergency Wage Subsidy as CEWS throughout the rest of this webinar. So for any of you who have seen our previous presentations or listened to our previous presentations, you'll know that we've been working closely with the Canada Revenue Agency really since the COVID-19 crisis emerged. Related to that, we've also been working closely with the Canadian Tax Foundation, and we've developed a list of issues and questions regarding the CEWS program and other tax measures related to COVID-19, and these summaries are posted on our websites. Over the past few weeks, there have been a number of developments, the key one being one that I'm sure you all have heard of, which is the CEWS program being extended to August 29th, 2020. But outside of this development, there have been a number of different changes that we want to highlight to you today. CRA has published their FAQs on the CEWS program. They've also published their application guide. In addition, many of you may have listened in to our conference call that we co-hosted with CRA not too long ago, where they basically answered questions around the CEWS program from our participants, and there was lots of valuable information within that call. Finally, the Department of Finance released a backgrounder as well as regulations on May 15th. This backgrounder basically announced the August 29th extension, but there are a number of other significant changes which we'll highlight to you today. So again, the focus of this presentation today is an update on the CEWS program, and we'll be spending the first part of this presentation talking about all these changes, what it means to the program, and how the issues on our priority list have been addressed or not. So with that, I'm going to start with some updates around the administration of the CEWS program. So the first change I want to mention relates to amendments. On our Q&A session, CRA announced that they would be launching an amendment process beginning June 1st through My Business Account and Represent a Client. This was a welcome announcement because up until this point, many were wondering how one could go back and make a change to a previously filed claim. And so this was good news to hear. CRA has indicated that it's going to be a fairly straightforward procedure. It sounds like it's going to be a box that you check off that indicates that you are making a change to a previously filed claim. So again, it should be relatively straightforward, and you can look out for it beginning June 1st. There are some open questions that we have presented to CRA with regards to the amendment process. The first open question is around the election using the cash method of accounting. As you might be aware, once you make this election, you really do need to stick to using the cash method of accounting for the balance of the program. It's unclear whether one can use the amendment process to go back and undo the selection made in period 1 if things turned out differently than what you had originally anticipated. So normally, as you all know, CRA would look down upon retroactive tax planning. But this situation, in our opinion, is a little bit different. First, an employer may not have made the claim right away, and if they did delay making the claim, they would have had the opportunity to do some scenario planning. This could mean those who did apply right away may have determined later on that it would have been more advantageous not to use the cash method. So we've asked CRA to confirm whether the amendment process will allow this change in accounting method, and we'll keep you posted as we hear from CRA. The second question we've posed to CRA relates to repayments of CEWS. Now again, given the uncertainty when the program first launched and the information coming out somewhat piecemeal, there could be a chance where an employer may have miscalculated their CEWS and it results in them receiving an overpayment of CEWS. Employers in the situation have asked how they might be able to repay the CEWS amount to the CRA. And so we've asked CRA to provide some guidance on this. We've also asked CRA to consider whether interest should be charged in this situation. Again, given the context of our situation in that there was a lot of uncertainty around the program, especially at the outset. The second area that I want to update you on relates to the attestation of claims. I'm not going to spend too much time on this because I think if you've been on the website or if you've gone through the application process already, you'll see the attestation is there and it's relatively straightforward. The form is called the RC661 and it must be completed and signed by an individual who has principal responsibility of the financial activities of the employer. So the attestation basically asks the individual signing to confirm that the application is completed to the best of their knowledge based on true and complete information, that they meet the requirements of the program, and that the employer will maintain records to support their application. This form is also where an employer would make their relevant elections under the CEWS program. Now, if you're a representative completing the application on behalf of a client, you need your client, the employer, to sign off on the RC661. And in addition, you'll need to fill out the confirmation section within Represent a Client, indicating that you'll provide, without delay in prescribed form, the completed RC661. CRA has indicated that an electronic signature is acceptable, and CRA has stressed that they can request to see a signed copy of this attestation at any time. So the final thing I want to update you on relates to, it really gives you a line of sight after you have submitted the claim in terms of what will happen next. So CRA has committed that their goal is to process CEWS claims within 10 business days. And they had mentioned to us that there may have been some delays right when the program launched, just given that it was a new program and a new system that they've launched. But otherwise, they have been largely meeting this 10 business day goal. If you are interested in finding out what the status of a submitted claim is, you are encouraged to call the Business Inquiries line, and that information is all on their CEWS website. Now, CRA has also stated that their primary goal is to get money into the hands of applicants as quickly as they can, but they are still going to be doing some pre-payment verification activities. And that could include a potential phone call from CRA to gather further information that might be missing in order for them to process the claim. So this has caused a little bit of concern in that taxpayers aren't normally used to getting calls from CRA, and CRA has had some issues when they've reached out to taxpayers or their representatives. And so CRA has indicated if you do get a call from the CRA, and you're not comfortable with the legitimacy around that call, you can always ask for the individual's name, and that agent will provide you their first name and last initial. And you can then call CRA back with that agent's name, and then you can proceed with your discussions from that point on. It's important to also note that there may be post-payment verification activities carried out by CRA as well. And CRA has indicated to us that they do understand the importance of providing certainty on an employer's claim, and thus any post-payment verification activities they'll try and do as quickly as possible. We understand from the CRA that this could be as early as June or July of 2020. So with that, I'm going to turn things over to Bruce, who's going to talk about some of the priority issues on our summaries that we've submitted to CRA with regards to CEWS.
Well, thanks, Vivian. So as Vivian mentioned, we do have a list of priority issues that we've been working on. We've been continuing our work with the Canadian Tax Foundation along with the CRA, and we formed a subgroup to work on it. So that work is proceeding. There have been some developments on some of the items, and that's what we wanted to update you on. And also where there hasn't been as much activity, we wanted to highlight just what's being done on those questions as well. So I think we'll just move right into them. So I think probably the key thing that got resolved, and Vivian mentioned this, is the release of regulation. It's Regulation 8901.1. And this was a regulation that added prescribed eligible entities to the CEWS rules. So this took care of one of the bigger issues we were dealing with, and it was of interest to a number of people because there were a number of businesses that just didn't seem to fit as eligible entities. So essentially, there were a few different things. One involved partnerships, Indigenous businesses, and private schools. So I'll talk about each of them, and we'll start with partnership one first. In the partnership situation, we were told that there were a number of business arrangements that just didn't quite fit the rules. And the issue revolved around the fact that one of the partners was a non-eligible entity. So it wasn't one that met the rules on its own. There were a number of different possible scenarios here. Probably the most common ones we heard about were when pension funds or private equity funds were involved. As a partner, they weren't eligible depending on how it was set up. Another common one was public-private partnerships, when a public entity, such as a crown corporation or that sort of entity, was a partner. So those caused issues because you had to have all eligible entities in the partnership, essentially. So the regulation actually added some prescribed entities. And on this issue, essentially what they said was it's okay to have non-eligible partners as long as they have a minority position. And that determination on majority or minority will be based on fair market value. The second issue that we were tracking, similar in some ways in terms of partnerships, and a bit different for Indigenous businesses that were just being run through a corporation. The original definition of eligible entity did not have a reference to Indigenous businesses that were exempt under tax in a couple of provisions in Section 149. So this was a concern. But again, this has been resolved because in the regulation, it does refer now to Indigenous government-owned corporations that are carrying on a business and are tax exempt under two of the rules in Section 149. So I think that issue has been resolved as well. And similarly, they dealt with an issue where Indigenous groups were involved as partners in partnerships as well. Another issue that got a lot of attention and a lot of emails coming our way was in respect to private schools. Again, the specific rule actually precluded them as eligible entities. And I think part of the issue probably revolved around the fact that the government, I assume, thought some of these were receiving public funding. We heard that many or most don't or didn't, and the government did listen and added private colleges and private schools to be eligible entities for the purposes of the subsidy. And although these weren't issues we were tracking necessarily, they also added registered Canadian Amateur Athletic Associations and registered journalism organizations as prescribed eligible entities. So these changes will be basically retroactive back to the beginning of the program, and the regulation is in place, so these organizations can go ahead and make start making claims if they haven't already. Another rule that we've been tracking, and this is getting into subsection 125.7 sub 4. And this subsection has some of the rules they introduced to help issues with corporate groups and those sorts of organizations with multiple entities. And one of our questions dealt with paragraph B in that subsection, and that dealt with a situation where you have an affiliated group. Essentially, the rule that they put in said that if you had an affiliated group, they could elect to essentially use consolidated revenue when deciding whether the entities in that group met the revenue test, either revenue decline exceeding either 15 or 30%, depending on which period we're talking about. So we asked a number of questions. The CRA has updated a couple, so I'll provide the update part first, and then I'll talk about a couple of things that are still maybe a bit more uncertain and where we've still asked for a bit more information. So the one question that came up was, what was an affiliated group for this purpose? I think a lot of us were assuming it's affiliated persons or a group of persons in the Income Tax Act. but it wasn't really specific. So the CRA has clarified in their FAQ that they are using that income tax definition. So I think we have some clarity there. The other thing that came up is a question that the CRA has resolved, I think, in the same FAQ, is there any ability to sort of decide which group to include? And maybe the issue it might be best sort of dealt with maybe by a quick example. Perhaps you have a situation where you have two totally different groups of companies carrying on different business activities, and they really don't deal with each other, but perhaps are controlled by the same person or the same corporation. The idea was that some people asked, since these smaller groups do form you know, an economic group, you know, on a sort of a notional basis, is it possible to use this affiliation rule there? The CRA actually, I think, has answered this fairly clearly. They've made it pretty clear. We think that if you're going to use this election for an affiliated group, it has to be the whole group. So in that situation, all the affiliated eligible entities would have to agree to use consolidated revenue as opposed to calculating the tests themselves. So I think it might not be the answer some wanted, but it does appear fairly clear. So I think the question will be, as it was before, you'll need to figure out, I guess, whether you're better off sort of doing the determination company by company or electing to combine it all. And I think the goal would be to see how many, you know, how many entities end up qualifying one way or the other to see which method gives you the best answer. Now, there were a couple more uncertainties. One of the examples in the FAQ talked about a husband and wife who each own a company, and talked about how they could elect to use this rule and calculate consolidated revenue. The issue we did mention to them is we're not sure that the terminology is correct in terms of consolidated, and we asked them to think about whether it can be combined revenue as well. The other thing that's come up is just how do you apply it in an affiliated group that includes non-resident organizations as well. It's a bit unclear how it works there in terms of especially how revenue is calculated. So we did on this issue, and on the other, the last one in terms of the husband-wife example, we have sent some material to CRA and just some more information, I guess, on why we think there's an issue with those two areas, and also a couple of FAQs. One sort of an amendment of the husband-wife one, and the other was a brand new one for an affiliated group that includes a non-resident entity. So we'll keep you posted as we hear more on that. Unfortunately, the other rule here, we can't give you much of an update on it, other than to, I guess, tell you what we've been doing with CRA. And this is paragraph D in the same subsection we've been talking about. And in this situation, this is the one where you have, say, a controlled group, and you have employees perhaps in one company, and you have the external revenue in another company. And the issue was how do you deal with the fact that you can't include non-arm's length revenue in the revenue test, while the company with the employees doesn't have any arm's length revenue. So one of the fixes was this rule that allows you to sort of look to the other entity to figure out what its revenue was from external sources. And if all or substantially all of the revenues coming from these non-arm's length parties, you can use that as instead of the revenue of the entity itself. This rule's pretty complicated. I mean, I guess it's fairly straightforward in a very basic situation like the one I just said. Maybe you only have two companies and all the revenue, all the external revenues in one company and all the employees are in another company. It's relatively straightforward. It begins to get more complicated though, again, where there's non-resident involvement. And also there have been questions about really complex entities where there's a flow of money that goes between multiple, or flow of revenue, I should say, that goes between multiple companies. So Again, the discussions here continue. We have provided some information similar to the last comment, some background information and some suggestions of examples to CRA. On this one, for those of you who've seen the FAQ, you might think this one's a large problem and maybe it's the end of the story. I think the news so far hasn't been good, but we're not sure we're done with this one yet. So I'll sort of preface it before I discuss the issue that I think there's still a chance for some more discussions. So this one involves cost sharing arrangements and Paymaster agreements. And there's a number of different variations, but I think the main issue in most of these is the fact that for one reason or another, and a lot of it's often logistical, but one organization takes care of paying employees that are really working for another organization. I think one common example is medical groups. You may have one entity that takes care of nursing and administrative staff for the group, and each of the individual medical practitioners don't have their own payroll. It's sort of taken care of centrally, and then they reimburse for their costs and essentially treat the individual involved as an employee for all other purposes. And there's other examples in the charitable sector, and there are a number of different variations. So we have been addressing this issue with CRA, and CRA issued an FAQ answer, which I think is correct. The rules are fairly clear. It does talk about an eligible entity having a payroll account at a certain time. So it does appear legislatively that there's a problem. So we, as I say, our next step is to just have another discussion with finance on this. We did have a discussion previously, so they're aware of the issue. So we'll follow up with them again to see if they've been giving any thought to perhaps including a legislative fix for this. Another issue that has come up is business combinations, and there's a couple of scenarios. One would be where you amalgamate or wind up corporations and combine them. So that's one situation. Another issue is where you buy a business as an asset purchase, and there's no change in entities per se, but there certainly is an internal change in terms of the business structure because you've added new business activity by purchase. So we'll deal with the amalgamation and wind-up part first. So the CRA had taken, questions from us, and we'd all had a discussion with them. I think it became clear early on it would have to be a legislative change. So there is some good news here. In the May 15th announcements in the backgrounder, the Department of Finance stated that they will put in a rule that essentially allows you to look at pre-amalgamation or pre-wind-up corporations to see what their revenue is. It effectively allows you to apply the revenue test, because otherwise there's a problem, because the entity that you're looking at right now is combined of some prior entities that were carrying on business, and that amalgamation essentially provided a barrier to looking at the previous revenue. Just as an example, if you had an amalgamation in December, you'd have a problem going back and applying the comparison test to the previous year, the same month, the previous year. So if you were looking at May, for example, comparing May 2020 and May 2019 would be a problem. For wind-up, the parent entity stays the same, but you still have the same issue because you have a lot more business activity this year than last year if you combine two active companies. So I think there is good news there. They'll essentially allow you to look at the group on the same basis, so you're comparing apples and apples. So that's good news. It's going to be, I think, harder to find an answer on the asset purchase situation. So the issue here, maybe it's the same idea as what I just talked about. In December of 2019, you bought a new business, but you did it as an asset purchase. So again, the business you're comparing this year to the same month last year is much different because the one now includes this new business that wasn't there before. So the issue is very similar, but this is going to require a legislative fix, I think. I think it'll be hard for the CRA to administratively allow you to bring in adjustments to, deal with the asset purchase, because the rules are fairly clear. It's a by entity test, and the entity last year and this year hasn't changed. It's just what's inside it. So on this one, we probably do need to talk to finance a bit more. Another issue that came up pretty early, and I think there's been a partial answer to it. It's we'd like to see something a bit more formal on this one, but we asked CRA just how should you deal with hedging transactions. We mentioned to them that they can be pretty complex. They can involve realized and unrealized gains and losses. They're also unusual, I guess, in terms of when these income or revenue impacts arise. They don't happen on a regular basis necessarily. So we did ask the CRA. I think the answer we got back makes sense, although, as I say, we probably like to see something more formal in writing. But during the conference call that we had with them, where they were answering member questions, this one did come up there as well. And CRA said that the revenue for the subsidy should be computed based on the entity's normal accounting practices and not how the revenue is actually taxed. So I think essentially they were saying that you would look at how these transactions are booked into revenue. So, well, like I say, we will follow up with them to see if we can get something a little more formal and maybe even an example. Another issue that the CRA was asked to deal with, because it's fairly common, is just how do you treat investment income? So this would be interest or dividends, perhaps, for the revenue test. So how would that work? And the CRA said that, again, it's a very similar answer to the previous one. Again, this will be based on normal accounting practices. And they said, essentially, if you have interest in dividends from investments as part of the ordinary activities in Canada, and if it's not an extraordinary item or on account of income or account of capital, I should say, you'll include it in revenue based on how you do it under your normal accounting practices. So essentially, again, you just include that this year and last year and do the comparison along with all your other revenue. Now, another issue that has come up, I guess, when we've been asking these questions, and we've been asking them, for example, the hedging one was income or losses, realized or unrealized. We've also had the question come up, and we will probably pose it to the CRA, but I think we know what the answer is, which is foreign exchange gains and losses on account of income. I imagine the CRA will say, again, you include foreign exchange gains on account of income, in other words, not capital items, in revenue based on your normal accounting practices. Whenever we ask this question, though, they don't talk about the loss part so much. So I think the issue there is a loss on hedging or foreign exchange loss, is that even revenue in the first place? I think there's some doubt there for sure. So, but again, we will try to get a little more certainty on some of these kind of transactions. One rule I wanted to highlight, not so much because we have an update on it, but more because it's an important rule to consider. There is a disclosure rule that's unusual here. This is unlike anything in terms of tax, I think, anyway. There are other rules, I suppose, the new rules that are coming into place on corporate transparency and that sort of thing. But for tax purposes, you generally haven't had to have sort of a public record that you've claimed something. But in the case of the subsidy, that's the case. There's a rule that allows the CRA to disclose people who have made an application for the subsidy. So that is something to keep in mind. we're not totally sure what the purpose is. I think, one thing is probably fairly certain. I think the one idea I'm sure is the CRA is worried about errors and probably misrepresentations and fraud as well in terms of these rules. There's a lot of money involved in the program. And I imagine part of their thinking was if there was public disclosure of entities that are claiming this and someone sees that and thinks there might be an issue, that would certainly be a way for the CRA to get more information. We also wonder if it goes beyond that. The one thing I think to give some thought to, because this was one of the issues we were sort of prepping on when Joy Thomas and myself appeared before the House of Commons Finance Committee. One of the questions that we were asked to get ready for, but as we were getting prepared, is what happens if someone asks a question about how the money is used. So you get the subsidy money and then maybe you use it to do a share buyback or something like that. So we wondered if that was maybe part of the reason for the public disclosure as well. The government can't really, and the rules don't require any tracing of what happens to the money, but we wonder if this disclosure rule is another way to sort of somehow govern, I guess, how the money is used. Again, we're not really quite sure exactly how CRA is going to go forward with this, but it is something that you need to keep in mind. I think that there will be potentially public disclosure. Another issue we were tracking is how the rules work with a partnership. So the situation I'm thinking about here is where you have a partnership that has employees, and it is, let's assume that it's an eligible entity itself, so it can claim the subsidy. And then you have partners that are also have their own revenue, have their own employees, and may or may not be eligible for the subsidy depending on their revenue test. We haven't had any information yet in terms of how it'll work for the partners. The partnership's relatively clear in terms of how the rules work, but the impact of the partnership activity on the partner isn't as clear. And I think the main issue is, do the results of the partnership somehow influence the revenue test of the partners? So we are looking for more from the CRA on that. Just how do you sort of account for the activities of the partnership when you're doing the revenue test for one of the partners? So I'm going to turn it back over to Vivian for some more updates on the subsidy.
Great. Thanks, Bruce. So there's just a few more items that we want to give you an update on. These aren't issues necessarily on our priority list, but we thought it was important to give you an update on some recent developments or that CRA has provided. The first issue relates to work in progress for professional firms. And the next two issues you see on this slide really relate to the temporary wage subsidy and its interaction with CEWS. Just as another note, temporary wage subsidy, I'm going to be referring to as TWS moving forward. So the first issue, WIP for professionals, as many of you might know, WIP is generally recognized as revenue as work is performed or when it's billed. There were many questions we received from our members, and it came up in the Q&A session we held with CRA as well, where many participants were asking whether professional firms should include WIP in revenue for the purposes of computing, for the purposes of the revenue test, of the CEWS. CRA indicated that how WIP is included for income tax purposes is not relevant for CEWS revenue computations, and what is relevant is whether WIP is included as revenue under the employer's normal accounting practices. So again, similar to some of the comments Bruce mentioned earlier with respect to hedging and portfolio income. I do want to remind everyone, however, that the cash method accounting election can be used to exclude WIP if that's what you wish. So moving on to some of the issues related to the temporary wage subsidy and CEWS. Some of you might recall, if you've been following along since the beginning of all of this, you might recall that the TWS was actually one of the first tax measures that was announced soon after the COVID-19 crisis emerged, and legislation came out rather quickly after it was announced. If you do want more information on the basics of this particular program, we do have a blog that we did up on it back on April 2nd. And again, you'll find that on our website. But basically, at a very high level, the TWS works automatically by deeming an employer who's eligible for the TWS to have over-remitted on their income tax source deductions. And if an employer is to claim it, all they simply need to do if they're eligible is to reduce their income tax source deductions that they would make on behalf of their employees. Many employers took advantage of it, but many, we understand, did not do anything with this at that time. Fast forward to when the CEWS was announced and then subsequently launched. Legislatively, the CEWS rules require that you reduce your CEWS by the amount you're eligible for the TWS, whether or not you claimed it. This amount in particular would have to be reported in your CEWS application as a reduction on line F. So again, many employers at the outset in particular may have just included nil on line F with regards to TWS, thinking that they didn't claim it, so that it should be zero. But legislatively, that technically wasn't correct. And technically, they'd have to go back and amend the CEWS application by the amount of TWS they are eligible for, and then adjust their payroll remittances accordingly. This seemed to be an administrative burden not only for taxpayers, but CRA as well. So there's some good news here. There have been some recent changes that provide relief around this. First, the May 15th background regulations actually on the TWS basically now indicate that the TWS is computed as 10% of the remuneration paid, or a lower percentage if the employer elects for it. So this essentially allows for an employer to choose to not to claim the TWS by electing a percentage of 0%. So how the employer can elect for this 0% rate really came out as part of the May 19 update to CRA's FAQs on CEWS. And in question 21, they indicate now that if the employer completes the CEWS application and did not enter an amount on line F for the TWS, the CEWS will basically be determined as if the employer had elected a TWS rate of 0% and therefore claiming the maximum CEWS. So CRA's FAQs were also updated to indicate that the employer should indicate the 0% election on the self-identification form under the TWS program. So this is good news, and I think it alleviates a lot of the kind of administrative burden that the legislation had originally required with regards to claiming the TWS. There's a few things I just want to make mention, however. At last check on CRA's website, which was this morning, CRA hasn't updated their application form or the application guide or the instructions around the application form to reflect anything I just described here. The only thing that has been updated is FAQ number 21, which is what I just discussed. So I'm guessing that's probably just a timing delay. I mean, the fact that they updated their FAQ, I think means that the regulations have been updated. I think it's just a matter of time for a CRA to catch up and update their systems to reflect this change. But you should keep an eye on this. The second issue related to TWS and CEWS was a common question that we heard, and it was a question that CRA received during the Q&A session we held not too long ago. And the question is, does the CEWS need to be reduced by a TWS claim for an employee whose salary is not eligible for CEWS? And this situation could arise, for example, when you have a non-arm's length employee who had no baseline remuneration and therefore not eligible for CEWS. The answer that CRA gave during the Q&A call we had with them was a little unclear, but we subsequently followed up and reviewed the legislation, and the legislation does seem to be clear that all TWS claims that the employer is eligible for will reduce the employer's CEWS claim. We asked CRA to confirm this understanding, and in a call just earlier this week that they had another Q&A call that they held, this question was asked again, and they did clarify that the understanding that we had was correct. That you do indeed need to, that all TWS claims that the employer is eligible for will reduce the employer's CEWS claim. So the final change related to CEWS that we're going to discuss today relates to an alternative baseline period that was introduced as part of the May 15th backgrounder. This option was really introduced to provide some flexibility to employers of existing employees who may not be regularly employed in early 2020. So they may be seasonal employees, or perhaps they're on a longer term leave. This proposed legislation basically provides such employers with two options for their baseline period. The first being January 1st to March 15th, 2020, and then the new option being March 1st to May 31st, 2019. So the choice of which period to apply can be made on an employee by employee basis, and this change is retroactive to the beginning of the program, essentially. So we have received some question on whether taxpayers can file based on this proposed legislation, and we did pose this question to CRA. Their response to us was a little bit mixed, but they basically indicated that they can't advise businesses to file the CEWS claim on the basis of proposed measures, but they also kind of indicated that they don't necessarily have the systems in place to hold CEWS claims that businesses file on the basis of proposed measures. But they did note that if a business files on the basis of proposed measures, and then by chance these measures don't get enacted, it's up to the business to go back to bring their affairs back into order to reflect legislation. So that wraps up our update on CEWS. You'll see on this slide here, we have a number of CPA Canada resources that we've kind of mentioned throughout this webinar so far. I believe a PDF of this slide will also be available, so you can just click on these links after the fact to review any of these resources. So moving on, we did want to give you a quick update on some non-CEWS related matters. And as a quick reminder, we do have a non-CEWS issue list up on our website. And again, the URL is here for you to review. A few key updates. So CRA has posted some guidance on international tax issues with respect to COVID-19, and that was posted earlier this week. They include updates on residency and carrying on business in Canada, as well as waiver requests and dispositions of taxable Canadian property. So if you haven't seen that and are interested, that is up on CRA's website under their COVID-19 updates page. We also understand from CRA that they're actively considering their policies around employee benefits and expenses as a result of COVID-19. I know that's a question that we've received from many of our members. And also they're looking at other forms that can be filed electronically. So we'll keep you posted on both those fronts. In addition, when you review our non-CEWS issues list, you'll see that we do have some GST issues, both technical and service related, as a result of COVID-19. And we continue to have active discussions with CRA's GST group on these, and we'll continue to keep you updated as developments arise.
So on that note, I hope that everyone stays well, and we'll continue to provide updates on issues as they arise to help you get through the issues that you are running into during the pandemic. So thank you very much.